morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. All right, we're talking about investing this morning, in particular with the markets getting off to such a rough start. In fact, the roughest, this is the worst start for the stock market in the history of the stock market. In 6 weeks' time, we're going to, in fact, what I'll do is I'll show you a couple of things real quick here. And then we'll give you an offer on how you can get an investment analysis of your own portfolio. But let's start first with looking at the Dow Jones Industrial Average. If we look at that just year to date now, right? We just closed this out. I knocked this chart out last night. You're seeing the Dow Jones Industrial Average with a negative 10% year to date. So that's as of close of the market yesterday. And now if we take a look at the next one, the S&P 500, you can see it's down about 10.5%, again, just since January 1st of 2016. So in the first approximately 6 weeks of the year, we're down about 10.5%. Now here's an index you may not have seen before, and this is called the Shiller Index. And the Shiller Index, Barclays Cape, this is something that's relatively new. Dr. Shiller won the Nobel Prize in Economics in 2013 in developing in his equity research. One of the things we see with the Shiller Index, as you can see, it's down about 6.6% year to date. Now that compared to the markets, you might feel, well, that's a difference of about 4% there. That's not so bad. That's more in my pocket. But you can see still a lot of volatility. Now if we look at that longer term, and I'll get into that, I'm going to break these down later, but let's look at the next one, which is the JP Morgan Mosaic. Now you can see the Mosaic is actually up about 5.3% this year. And this is one, both the Shiller Index and the Mosaic Index are relatively new indexes. The Shiller more so. It's something that's only been around a couple of years, but they're starting to, but the back testing is what I'm showing you, as well as the year-to-date numbers. But we're going to get into some back testing to show how that works. The Mosaic's been around longer. And again, here we're seeing just on that year-to-date, that's pretty good. If you can get a how many people would rather like to get a 5% gain in the first 6 weeks of the year, of course, compared to those negative 10s. Now if we look at the next slide, this has to do with the average investor, and I've shown this one before, investor returns. And one of the things, if we're looking at the S&P 500 index over the long term, okay, you can see pretty positive numbers when you look at the, so if you look to the, what would be the right of your screen, you've got the Barclays Aggregate Bond Index, and right next to that, the S&P 500 Index. And you can see if you look at the 30-year return at 11, the 20-year return at almost 10, the 10-year return at about 7.6, 5 years at 15% a year, 20% a year when we look back 3. Now that's not counting, okay, 2016. All right, these numbers are through 2014. So once we get the new numbers in from 2015 and 16, obviously these are going to adjust downward. All right. Now this is the biggest thing I want you to see here, though, if you look to the far left of average equity mutual funds, is that they get about half the return. In fact, in many instances, less than half the return of the S&P 500 index. All right, so what does all that mean? It has to do with stock market volatility, of course, but also that the average mutual fund, we're looking at the Dalbar returns there. Dalbar is an independent research group that gives us, every year comes out with the Dalbar Investor Report, which has to do with how the average investor does in the stock market compared to the indices, okay, such as the S&P and the Dow Jones and the Barclays Aggregate Bond Index. So these are, in other words, the broader stock market and the broader bond market. We also can look at internationals, emerging markets, and the rest, which we see, the Nikkei average is way down again. So a huge drop. I think it's around 5 or 7% in one day, and we're seeing again a big drop year to date there. The key here is knowing how we're going to protect ourselves in this volatile market when we start seeing all these different asset categories taking big hits, reminiscent of what happened in the from October of 07 to March of 09. So I'm going to show you some ways to protect yourself, and I'm going to give you an opportunity, in fact, to get a specific plan just for you. We're going to get into that as soon as we come back. Quick break. Join us here. We'll be right back on the Retirement Report.